Hi, Steve Van Metre here, and welcome to your weekly economic update. We take about 30 minutes every Friday, trying to make sense of markets that, don't really make any sense. After all, if they did, I wouldn't need to make these videos, and you wouldn't need to watch them. But together, we get smarter, and I think that's great. You've sent some great questions in for this Friday video, and I'm excited to answer them. But before we do that, I had this hunch, this feeling on the way to work, and I just can't explain. I'm like, today is going to be a good day for the bond market. Okay, well, maybe that was how I interpreted the feeling, but I just had like, man, something good is going to happen today. And bam, it did. And I couldn't have predicted it because probably in the last hour, I was like, maybe it's not going to happen, but there it did. So pretty cool. After all, we are in the economic event of probably our lifetimes. I mean, the world is being shut down, and yet people are bullish about stocks. Isn't that weird that people are like, the bottom is in? No, it isn't. The bottom is in? No, it's not. Bottoms are processes. They're not a 1 week event. It's amazing that people think, but the market must think. The market doesn't think anymore. Do you realize that this is a computer-controlled market? You want to have a human-controlled market and know what humans think? Go back to before the during the great financial crisis and any time before. Today, it's all computer controlled. So what's caused the market to go up? For the most part this week, even though the trend is lower, we do know, I just lost that thought really quick. Yes, here we go. That pension funds, institutional money managers, and even large sovereign wealth funds are rebalancing at quarter end, or they believe that stocks are cheap, so they're adjusting their allocations, selling bonds, buying stocks. We also have heard that corporate insiders, now usually this is a key to market bottom, but may not be such a key when you're out asking the government for a handout, right? So my guess is some politicians were telling CEOs and executives, look, might make the situation look a lot better if you go and buy a bunch of your stocks. So we've seen corporate insiders buying. And what happens when markets go up and you're in a computer traded world, models will play chase. So whether they're quant models versus parity models, whatever models are out there, and there's a bunch of them, at some point, as markets trend up this way, no, that way. God, it's terrible, isn't it? I'm not good with this reverse thing. Let's see now. There we go. As they go up, the computer models start to play chase. Doesn't mean they're right. The problem with these markets is you get moves like last night, where after the market went up, the futures market went down. And the coronavirus is a huge variable. If anybody thinks that the economy gets better when humans are stuck at home, unable to work or consume, and their incomes are going down, I don't know what you're thinking. I can suggest to you when you do go out, and not that I recommend that you do, but if you have to go out, talk to some local businesses. I talked to my dry cleaner this week, a nice young lady that works there, and I walked in and I said, how's business? Is it bad? And she goes, oh, it's really bad. And I said, like, how bad? Like down 50%? So I'm fishing? She goes, oh no, way worse than that. She told me how bad it was, to the extent is they've cut hours, they're scheduling week to week, and they're not even sure they're going to keep their doors open much longer and go to strictly a pickup and delivery service. I look at another good example, find out how the economy is doing, is talk to your barber, which you can't go get. So here in a few weeks or more, my hair will get into outrageous sizes as time passes. But these people don't have a second income. They cut hair and they work from haircut to haircut to paying their rent, and they're closed. You think that's bullish when these people just don't have money? Yeah, it's not. Now let's get into the questions, because I'm really excited about some of these. I'll start out, and just so you know, I read these word for word, so be careful what you send me. You said that only banks can create money by lending. That is correct. But banks don't lend against their deposits. They do lend against their deposits, i.e. they cannot lend more than their deposits minus reserves. Okay, so banks, in a full reserve banking system, it'd be dollar for dollar. So if there's $100,000 on deposit, a bank could lend $100,000 out. That is it. But we are in a fractional reserve banking system set by the Federal Reserve, who says we can lend 9 times against deposits. So if there's a $100,000 deposit, the bank can create 900,000 of fictitious money, so 100,000 can become $1 million. So that's how it actually works. So no new money should be created in the system. It is created when people borrow. And by the same token, it's destroyed when they repay against the principal of a loan. Now, it doesn't mean you're making a principal payment. You can have a fully amortized loan, and every payment you send in, there is a chunk that's going to principal and it's being destroyed. So it's very important to understand. Anytime a payment goes to the principal value of the loan, that money is destroyed and removed from the monetary system. That is how a debt-based monetary system works. Why, or a reason why the coronavirus is such a problem, because if you're stuck at home, how are you going to go borrow? 3.3 million people hit the unemployment line, and yet the stock market says it's bullish. How are these 3.3 million people going to go borrow money? You think they can get a car loan? No. Home loan? No. Loan for a TV? No. But the problem is people are making payments on debt every day, but there's not a lot of new debt being created. Therein lies the problem. All right, next question. Crazy market rally these 3 days. Yes, hope I didn't miss the bottom. You didn't. I know you believe we'll go down much further. Yes, I do. And we may get a second chance. You will get more than a second chance. You'll get 2 or 3. Maybe the next video you can elaborate. Yes, I will. Let's go to the charts, because when you're not sure, go look at history and it'll tell you everything you need to know. Let's go back at the S&P 500 and we'll go to the, nope, I want to go further to that, the .com bottom. So let's pretend this is the bottom everyone thinks it is, that it's not. Reality is we are somewhere up in here, higher. But anyways, or maybe a move like this, but let's just pretend we're down here. Market bottoms are a process that can last 9 months or more. So look, if this was the bottom, we should get a confirmation of it. And if that is the bottom, we should get another confirmation of it. So here's effectively a triple bottom. You could almost say it's there's a little head and maybe a left shoulder, right shoulder, not a very pretty head and shoulders reversal, but there you go. If we go and look at the SPY, the ETF, look at the trading volume too. You notice how the trading volume just goes off the charts near these bottoms? That is the retail investor, the public selling their shares. So that is validated there. Now let's go to the 2008. No, I did that before. Where's 2000? Here, 2008 bottom. You get a left shoulder, head, kind of lazy right shoulder. But notice, big spike in volume as people are selling, and then a second chance. Here's your second, or maybe a second chance in here, third chance in here. And look, market bottoms do not go shooting straight up. They eventually just slowly go because people have lost interest in stocks at that point. All right, next question. How will you know in retailer stores? Okay, I think there's some confusion on when I say retail investor. So let me reword this. How will you know retail investors buy bonds, and how will you know when retail start to sell stocks? Good question. So when I say retail investor, I do not mean retailers like a store. I mean retail investor is someone who is managing their own investments, or to be more specific, someone has a 401k, because most of those are self-managed, someone who has an IRA that they self-manage, or even someone who has a financial advisor that would call them up and say, I want you to sell because I'm not happy. Why do people end up selling at the bottoms? There's 2 very important reasons. One, the pain is too much. They've lost too much money. Literally, the financial system is crumbling down around them, and they want to hang on to whatever they've got. So they sell it, go to cash. And they might buy bonds, but even buying money market is a bond equivalent. Because remember, money markets are 3-month treasury bills for the most part underneath. So there you go. The second reason is you're losing your house, your job, your kids need to eat. Financial uncertainty is all about, and your world is crumbling apart. So you sell, you cash in your investments so you can eat the next day. That's why the public sells, the retail investor, the general public sells the most in the bottom, because they need the money. All right, that's a good question. Next question. What is the impact of the Fed QE on VIX and the implied volatility of market indices options? I'm not going to answer the second question, because remember, these are your questions, my answers, but no trading advice. None, not a zippo, zilch. So what is the impact of the Fed's QE on volatility. So let's go to the VIX. And what does QE do? It causes rates to go down. So let's overlay 3-month Treasury yields, IRX, 13-week, close enough. And we'll zoom out. And what you see is when yields fall from QE, volatility goes up. So yields fall, volatility goes up, yields fall, volatility goes up, yields fall, volatility goes up. And add a second question view to this is market bottoms. You don't have market bottoms when the VIX is sitting at 65. It would need to be falling. Okay, good question. Next. Oh, I like this one. People seem to incorrectly assume the Fed's balance sheet expansion will create domestic inflation or hyperinflation. Let me restate that question. Nearly every investor and a large number of professionals, experts, analysts, and anyone who thinks they know about the markets seem to correctly assume the Fed's balance sheet expansion will create domestic inflation or hyperinflation. It won't. The Fed's buying bonds from the Treasury and primary dealers will not cause consumer good inflation, correct, because the money that the Fed gives these institutions stays in their reserves, correct, and only goes into the regular market when loans are made. Brilliant. Very, very good thinking here. I like it. Yet I hear the Fed is literally creating trillions of this pseudo money. It's not pseudo money unless, all fiat money is pseudo money, but yes, they're creating trillions of dollars. Is it literally trillions? Yes, it is. If so, there must be some negative repercussions. Is it possible or even probable? Let's answer the first one. Are there going to be negative repercussions? Yes, the Fed's trying to create inflation. They're going to create deflation. I know. Look, the Fed's like a lost sheep. No, they're worse than a lost sheep. A lost sheep will find its way home eventually. The Fed, they just they just go way off into the fields and fall off a cliff somewhere. They are absolutely clueless about their own policy tools. So yes, there are repercussions. Deflation or disinflation. The economy contracts, asset prices fall. All the things the Fed doesn't want, they're going to get. Is it possible or even probable the Fed will print 10, 20, or even $45 trillion? Yes. Without the stock market, bond market, or dollar crashing? No. The stock market will crash. The bond market won't because they're buying bonds. That's the whole point. The Fed's buying bonds. Dollar crashing? I'm not a great... my opinion on the dollar is varying. I'm not a currency expert at all. So I'm going to answer this indirectly when I answer another question. Will the Fed ever be able to sell this stuff, these bonds, back to the market? No, we tried that and that did not work. No, I don't think they're ever going to do that. Without the stuff they're selling collapsing in value. No, it has nothing to do with the Treasury's collapsing in value. It just has to do with the fact that at this point, deflation, interest rates are going to go to zero. We're going to be like Japan and the European Union where interest rates are permanently low and there's no inflation. There's no way the Fed will ever be able to sell this stuff. Okay, good. On one hand, the Fed is doing a QE operation and buying up treasuries, correct? ETFs, no. Bonds, only mortgage-backed. Well, they are okay. They're buying U.S. Treasuries and mortgage-backed securities. They cannot buy ETFs, and they're buying corporates and I think munis, but I don't know if they're permanent. I think they're kind of under a loan type situation. They're not a permanent asset on the Fed balance sheet because the Fed legally can't hold them. So I think there's some loan things going on. I haven't bothered to look at the terms because the Fed's so screwed up here right now, it doesn't matter. However, does it not have to issue treasuries? No, the Fed does not issue treasuries. The U.S. Treasury issues treasuries for the... Okay, so let's reread this. However, does it not have to issue treasuries for the massive fiscal stimulus? So the U.S. Treasury will issue the treasuries for the fiscal stimulus that was now approved by the Senate and now the House today, and perhaps signed by the President while I'm recording this, which I'm assuming is borrowing from the Fed. No. So what happens is the U.S. Treasury issues the debt. There's three people that buy it at auction: domestic bidders, foreign bidders, mostly foreign central banks, and securities dealers, which are owned by the large commercial banks. So large commercial banks then can in turn buy it off of the securities dealers. The Fed can only buy from the large commercial banks. So that's how they do it. So they're not buying, the Fed is not issuing and buying its debt back. There's a loop there that's got to occur, which I'm assuming. So how can they do both at the same time? They can't. Oh, from my good friend and neighbor, he'll now know who I'm talking about. Can you update the jaws of death chart? Yes, I can. He was actually trying to find it in an old video, and I said, why don't I just give you a new one? So I think we shall. We need to overlay the S&P 500. So what is the jaws of death? What this is it means that stocks and bonds, stocks and treasury yields, let me rephrase that, rise together and generally. They fall together generally. And so what you kind of see here, this may not be exact, but it's close enough for kind of my purposes. You can see that yields were rising, stock prices in purple, the S&P 500 were rising, yields were rising to validate it, and then that relationship broke down here. And it looked like we were headed into a bear market, but the stock market kept going due to corporate share buybacks, and then literally fell off a cliff when no one said that could happen. So yields are falling, and they're going to continue falling, which means stock prices are going to continue falling until yields get near a bottom or very close to it, and then stock prices will start to bottom. So the question is, will the jaws close? Yes, they will. These are alligator jaws. You can see the teeth kind of here. That's what they're referred to. So will they close perfectly and line up? No. But when yields stop going down, then you're looking at that 9-month bottom in stock prices. So there you go. All right, and then I have one more question that didn't make the list because I didn't put it on there. Is the Fed's reduction in QE good for the dollar or not? Now, I don't know the answer to that, but I'm going to answer it in an indirect way as soon as I get everything lined up here. Here we go. So from my friend in Hong Kong who did not know I was going to answer this in today's video, here you go, my friend. Today, we got the trade-weighted U.S. dollar in blue rising, as I kind of expected to, and the 10-year Treasury maturity rate. So the question was, with yields going down, is that good for the dollar? Well, historically, not so much. We see that and these are percent change from a year ago. So we see that yields are going to fall, and then they should be kind of rising. Now we can adjust this a little. Oh, you know what? I'm sorry. This is 10-year yields minus the consumer price index. I should have looked a little closer before I put this price. So what is this telling us? Is that consumer prices are going to fall faster than treasury yields. And in that case, which I believe is true, you see the dollar goes up. Now, I'm going to give you a much better way to look at it, a simpler way to look at it. Here's a trade-weighted dollar. Now we're switching colors. It's in red, rising. And we have hourly average earnings of all employees less the consumer price index. So what you see here is, going back to last recession, you see, well, wages were rising in blue. I'll give you a better explanation. Consumer prices were falling. It wasn't just that wages weren't really rising. It was consumer prices or deflation or disinflation was ensuing. And yes, that is dollar bullish. So absolutely, in an indirect answer to his question, yes, I think the dollar goes up. All right, now let's get on to our normal set of things. Let's take a look at the asset and liabilities at all commercial banks, and then we'll get into the charts, and then we'll come back to some of the stuff. And I want to add more evidence to the deflationary tune of what's going on and more data on why we're not at a market bottom. So as of the week ending March 18th, large commercial banks have purchased another $15 billion in securities. You can see they bought U.S. Treasuries and they've bought mortgage-backed securities, even as the Fed's buying. They're looking. I'm sorry, I said that backwards. They're buying mortgage-backed securities in mass, and they shaved a little bit off their U.S. Treasury. So they're buying a lot of mortgages, a lot of them, which is interesting to me. I don't have a specific explanation why, but overall, the banks are still buying bonds. Looking at total loans and leases, it jumped like somewhere around $250 billion. Huge jump in loans here. And the reason is mostly large commercial banks. Now, normally when you see this big jump, you're like, man, that's really bullish for the economy, except when you know there's corporations yanking their credit lines because their business models are failing because everybody's staying at home. So this is not bullish. This is actually bearish, but normally it would be very bullish. Real estate loans are up. No real surprise there because we know there's people have been refining, but this number should die off as refis collapse. Commercial real estate loans were up some. My guess is for the same reason as real estate loans. But look at consumer loans. Here's your validation that those corporate loans or commercial industrial loans aren't coming from consumer demand, because consumer loans virtually flat. So no demand out of the consumer there. So all right, so let's go to the PowerPoint slides. And we've got the M2 money supply. Now the money supply is just taking off here. Its growth rate is up to 9.42%. And I want to dig a little deeper into where that money is going. So I've got that for you right here. And that is not it. It's right here. And the money stock measures institutional money funds. This is money markets in your IRAs, 401ks, and things like that, brokerage accounts. And you can see, boom, big jump there. So that tells you that the money supply is not growing from a lending standpoint. It's growing because people are putting money in cash. And you can probably guess, if we overlay the dollar here for fun, let's just see what that tells us. Trade. I know there's a new dollar index, and I don't have the code memorized, and I don't know the easy way to look it up. So let's go and see. And so, yeah, when you see money flowing into money markets at a real steep rate, the dollar tends to rise because there's a demand for dollars. So a lot of cool things you can learn from these charts. So let's go on past the money supply to real estate loans. Now, despite the increase in real estate loans that we saw in the bank data, on a year-over-year basis, it's actually flat at 4.49, flat on the 6-month, flat on the 3-month. So really not a whole lot going on despite lower interest rates. How about commercial and industrial loan growth? Big jump. Again, this would be normally super bullish for the economy, but it's not, even though the growth rate is up to 8.52% from Mirka, literally straight vertical move. 6-month rate of change, everything is rising. And of course, that implies that all loans and leases at commercial banks would go up, mainly because of the commercial industrial lending. So not much to tell from here, but we'll be interested to see if this now flatlines and starts to roll over. And again, consumer, not validating that the consumer's outspending. Credit card growth rate is actually should be, say, down to 5.05, so it's sliding. So none of the growth in the commercial industrial lane is coming out of the consumer. And again, as I mentioned, these moves down in bear markets are called bull traps, and it's kind of looking like that right now. And this is interesting. We've seen this before from Nautilus Investment Research, and they updated it. So Dow Jones Industrial, looking back to 1929, in 40 days dropped 40%. We dropped 37% in 27 days. Back in 1929, it rallied 18%. Now we're up 21%. They did that in 2 days. We did that in 3, and then it fell almost another 30%. Take that for whatever it's worth, which may not be a whole lot. Interesting, but no confirmation that's going to happen. Let's take a look at the NASDAQ McClellan Summation Index. Good proxy of liquidity. Is looking like it's trying to bottom. We've seen it before where it's tried to bottom and then it's kind of taken another move down. Under normal conditions, this would be a massive buy signal, but right now it is not. Let's look at the monetary base. We can see the Fed has been busy doing some things, buying lots of treasury securities and mortgage-backed securities. And from a world dollar liquidity perspective, you thought I wasn't going to say those words today, but I am. Now, this is very important. The Fed is getting some dollars back into the economy, and world dollar liquidity, which we would normally add in the foreign held treasury securities, but we don't have that data except every quarter, is now growing at 16% a year. So this gives us a good proxy of that. So we can see the Fed's trying to fix their problems, but they got they're going to be way up here by the time this is done. They got a long ways to go before this party is over. Now, if we take the monetary base and we divide it by the M2, or we take the M2 money stock, divide it by the monetary base, make some mathematical adjustments, we get the money multiplier. And the money multiplier, as predicted, would head lower. This is how you know you get deflation, because Steve's layman explanation is this is how many times money multiplies before it dies. The actual definition is how much the bank, how many times the bank can lend against its deposits. So you can see it's falling to 4. This will go down even more. Now, how about from a stock market perspective? Let's overlay the Wilshire 5000. Now, the reason I'm not using the S&P 500 is that doesn't have the data for the S&P, the historical data anymore. Don't know why, but years ago they lost that ability. So I assume something with the Standard & Poor's Corporation did not go right for the Fed. And here you can see when the money multiplier is crashing, well, guess what? So too are stocks. And it won't be until the money multiplier starts to slow down its growth rate or its implosion that the stock market will fall. And you can see every time, you see it kind of hit here and it fell. But look at the timing. Literally, as the money multiplier falls, there goes the market. You can see right on schedule. So that tells us the stocks are nowhere near done, because the Fed's not done creating massive amounts of deflation. And what happens to deflation? Asset prices crash. We can also add to this narrative what happens to the consumer price index. I think it's CPI USA. Nope. Oh. There we go. Yeah, close. But no cigar. All right, we'll move this over to the right. And oops. You know what? Let's do this on a year-over-year basis. We'll make it a little easier to see. So what happens when the money multiplier crashes, you get a drop in consumer prices, you get deflation, disinflation. That is coming. There's your cue of why the dollar is going to go higher, even though wages aren't going to go up. There's going to be massive amounts of deflation. I told people years ago, I was thinking about buying a new car. Wait. Well, I think about buying it. Wait. Save your money and wait. Why? Because prices are going down. And you can even tack on, and we have done this in the past, 10-year treasury yields. And what we know are yields, we're just front running this move down and will continue to go down because yields fall during periods of deflation. So you can see the money multiplier is crashing and there goes yields. Money multiplier starting to crash and there go yields. So we got further to go on the yield story, and that is just my opinion on that. All right, let's go onto some charts and see what we can glean from them. What's fun is I haven't looked at too many of these today. It makes it more interesting when I have to do this impromptu. So the S&P 500, let's take a zoom in look. I have this theory, and it's unfounded, that markets will struggle trying to get past points of major rate cuts. And here it is today. It came up, hit 2,600 and failed and closed lower on the day, but higher on the week. And I thought 2,400 will hold. It didn't. Let's take a look at 30-year treasury yields. And you can see I said what rate cuts, if it goes over, it's coming back down. And sure enough, this actually closed lower than here because the clock on this cuts off 30 minutes early on yields. I don't know why. I wish it didn't, but it does. But so we'll go look at TLT. And now you can see this dotted purple line right here. This is about 1.3% on 10-year treasury yields. Let's zoom in. I said this was the last line of defense before we kicked some short sellers out. And look at that. Earlier today, I was like, oh man, whatever. I was sitting here like, yeah, this is not where's that good, feeling I had? And then all of a sudden, boom, there it is. Hello, massive short squeeze on the news that the Fed was going to scale back its asset purchase program a little bit. I don't know why that would cause a big turn. All I do know is this was a big short squeeze, and now we should start to see bond prices move up to squeeze out the sellers here. here, here, here. And when we get over this 181.41, boom, there's a massive bull market coming in bonds. I've said this was a bottoming pattern. There it is. You can see we broke through this overhead resistance level between these two purple lines, and then the last line of defense was right up here on this dotted purple line. I said this whole picture here looks like a Wyckoff cup and handle bottom with a check in at the last line of support, and boom, go. Yields are going to zero. At least that remains my opinion. Maybe I think they're going negative. And I'll remind you that here is the largest topping pattern in 10-year treasury yields. We have 1, 2, 3 bombs. I said, people here said you're insane. Yields are going up. I said, nope, there's no such thing as triple bottoms. It's going to fail. We're not going to get a quad bottom, and boom, there enough. We're headed to zero, probably negative, and that is pretty cool. What else do I want to look at? We'll go look at the dollar. I will tell you, I was a bit surprised. Now, I do not, for anyone asking, I do not personally or professionally buy currencies. I don't understand them enough because they make these massive moves. I mean, you can see, look at this, whoop, and back down. And this is overhead resistance. This is support. And I was expecting the dollar to hold it right into the support zone. It broke through a little bit. I still think it goes higher. But like I said, they move way too fast from B. But my data says it should go higher. Whether that be Monday or not, I don't know. But at some point in the future, I predict the dollar will go higher. How about crude oil? Got down to $20.88 and is now sitting at $21.84. This is not bullish for the economy. Anyone who thinks that stocks are going to go up with oil at $21 are crazy, because this just means small and mid-sized oil companies are going to go bankrupt. They're going to lay off lots of people. Not really that bullish. And I've got a lot of friends and clients that work in the industry and believe me, it's not something that you want to be excited about for them, because it's not. And long time ago, now that I see this, I forgot about it. I drew this line in that I stole from Raoul Pal, the CEO and co-founder of Real Vision. He said the oil would eventually get down to around 21 a barrel. There it did. He said if it falls through there, it's in trouble. It looks like it's going to fall through there. There's no demand when people are at home. Oh, and last thing I want to look at, and then we'll wrap up, is emerging markets. And emerging markets tell us that there are problems. It needed to hold, let me zoom back out, it needed to hold this purple line right here. And it looked like it was going to, but now it's seeing a reverse direction. This is just not that strong of a picture. It still tells me there is much worse to come here, and the emerging markets just give us that indication. This is a proxy for liquidity. And liquidity conditions are still tight. The Fed is still easing. And if there's any doubt, I can overlay, say, 10-year treasury yields. And you can see yields are still falling. And so emerging markets are going to too. Their yields are going to yank liquidity out of the markets, drag the market down, drag the economy with it. And that is not bullish, my friends, not at all. But what I am curious to see is how many hedge funds are still short the bond market as of Tuesday of last week. So we'll be back on Monday. If you have any questions, again, send me an email, send me a message on Facebook. Again, no trading advice, but I'll be more than happy to answer those. And until Monday, I'm Steve Van Metre. Thanks for watching. Have a great weekend. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation or buy, selling security, financial product, instrument, or to participate in any particular trading strategy. This video is prepared by Steven Van Metre on personal capacity. The opinions expressed via that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.